Hey, everybody out there with us once again is Mark Collinsworth of Vere Global Financial Wealth Management, here to talk about the economy, what is going on, how the market closed this week. It was down again, the latest inflation numbers, and the road ahead. So, Mark, we closed the week on Wall Street kind of in a down situation, not good news, correct?
Yep, another down week. Inflation keeps going up, and expectations for the Fed to even get more aggressive keep increasing.
So, what does this spell? We're a deeper recession than the one that we're already in?
I'm going to have to say yes because the Fed has been raising interest rates, but that's had absolutely no effect on inflation. Inflation keeps going higher and higher. The Fed's goal is basically they've got to get people to lose their jobs so they stop spending money.
Now, how soon will the next interest rate hike be announced by the Feds?
November 2nd will be the next Fed meeting.
Right before the midterm elections.
That's correct.
So that doesn't sound like it would be good news for the Democrats.
It probably will not be because the inflation number has gotten actually so bad that traders now are actually pricing in about a 20% chance that the Fed will raise 100 basis points or a full 1 percentage point at the next meeting, and expectations that the Fed will do 75 at the next three meetings are fairly high as well.
So far, it's been 75%, which itself is pretty steep.
Yeah, you have to go back to the early 1980s to see a Fed raising interest rates by that amount.
Now, despite this news, Biden was saying just the other day, some parents or wherever he was, that if you elect the Republicans and give them control of Congress in the midterms, inflation will get worse. What do you think of that statement?
I think someone just puts a script in front of the man and he just reads stuff and doesn't know what he's reading. How can you say the Republicans are going to cause inflation when the Democrats control the White House, the Senate, the House of Representatives, and every economist out there says all the Democratic spending has what's caused the inflation, and the Republicans want to stop the spending? It just doesn't make any sense.
Well, I think Biden and others in the party are referring to how the Republicans will reverse the Inflation Reduction Act if they take power, and therefore it's going to make things worse. Does that have any credibility at all, that argument?
That's a joke. I've seen numerous reports come out that they called it the Inflation Reduction Act because they want to put a bunch of junk in it and they thought it would sound good for voters. But there's nothing to the Inflation Reduction Act that will actually reduce inflation. To really drive the point home, even Bernie Sanders, when he got up there, he said the Inflation Reduction Act does not reduce inflation. I mean, you have a liberal saying that it doesn't do anything.
No, yeah, the liberal who was going to be the nominee until they maneuvered him out of that position, and Biden became the Democratic nominee and the president. Well, also now the consumer price index figures came out this week as well, and that was again was what, more bad news.
More bad news. Inflation keeps going higher and higher. You got to go back all the way to 1981 to find inflation that's anywhere comparable to where it is now.
So the consumer price index figure this week was what?
8.3, I believe.
8.3. That's the inflation, the current inflation rate.
Over the last 12 months, correct.
How about over last month?
Over the last month, it's up 0.3%.
Okay, so despite the rosy tinge that President Biden is trying to put on this, there's no real evidence that what he's saying is at all accurate in terms of the current state of the economy and where it's headed.
That's correct. I mean, again, someone just puts a piece of paper in front of him and he starts talking.
All right, now, yeah, getting back to the Fed, they keep making these interest rate hikes, 75%, 75, and the next one may even be a 1 percentage point, which again is quite a bit. It doesn't sound like much, perhaps, to people who don't understand the economy in depth, but I mean, a 1% hike has a big ripple effect on everything, all kinds of loans, mortgages, et cetera, correct?
That is correct. But the problem is that normally when the Fed rate increases rates, it normally takes about 4 months for that hike to fully work its way into the economy and actually start having an impact. Mm-hmm. Right now, we still have a good 375 basis point increases that really haven't even fully worked their way into the economy yet.
So when it does work its way in, the effect is going to be even worse.
Even worse because inflation's already slowing the economy by itself. So inflation is slowing the economy because people are paying more for gasoline and food prices. And then all of a sudden, here in probably the next 3 or 4 months, consumers are going to look at their credit card bills and be like, whoa, I'm paying a whole lot more in interest on my credit card. And that's going to be a big slap in the face.
All right, so once again, Mark, there's no doubt in your mind and many other credible economic analysts that we are currently in a recession.
You are in a textbook definition of a recession right now.
And what level is that recession at in terms of negativity?
It's barely in the negative zone, so you could call this a very mild recession. But at the same time, you have a mild recession, inflation is not coming down. Does that mean we're going to have stagflation, where you have no growth and high inflation like we did in the 1970s? But the key thing here is job growth we still keep creating jobs. Joe Biden likes to brag about creating jobs. But right now, the last thing the Fed wants to see is more job growth.
Yeah, I mean, that's part of the mechanism, right? To bring down inflation is to get rid of jobs.
Correct. It's simple as this. If you have money to spend, you spend your money on goods that drives up the prices. The best way to make people stop spending is raise interest rates to the point to where you get fired and you just don't have the money to spend.
All right, so if that plan comes off as planned and there's massive job losses, massive layoffs, how long will it take for that depression of jobs to rebound the economy once again? You know, how long will it be before there's an uptick in where the economy is?
Well, that depends on how fast the inflation rate comes down. So there's a lot of speculation and stuff out there, but right now, just looking at where people are predicting the Fed to actually start cutting rates, some people now have pushed their estimates all the way out until December of 2023 for the Fed to actually reverse course.
So therefore, we could be in for some real doldrums here and people unemployed for an extended period of time.
Right now, based on where the inflation rate's at and the Fed's aggressiveness, historically, if you go back to the Paul Volcker days, Paul Volcker made the argument that when inflation gets that high, the only way to stop inflation is the Fed funds rate has to go above the inflation rate. And I think you're already setting yourself up for a pretty bad recession if the Fed funds rate hits 5%. Now we're talking under Paul Volcker's theory, you're talking about a Fed funds rate going to 8%. If you're already thinking about a bad recession at 5, I can't even imagine what it's going to be like with Fed funds at 8.
So it'll be a significant recession. Will it border on a depression?
I don't think it'll be a depression level because the Fed still has ammunition to kind of reverse the process. But I could definitely see us being in a recession very similar to what we saw in 1974. And the 1974 recession was actually the second worst recession on the history books.
Wow. Well, Mark, not good things ahead. So again, you're a financial advisor. What do you advise your clients to do in this economic state of affairs, with the stock market going down and down? What do you tell them to do?
Put your money in cash, avoid bonds. If you got any exposure to commodities, increase your exposure to commodities like pork bellies or gold, silver, things like that, because things could get really bad here very quickly.
Now, what I find very interesting about this from a layman's perspective is it's my understanding that bonds used to be the safe haven, right? If you don't want to speculate on high returns from some stocks because they're volatile, you would go with bonds where the returns would be less, but it'd be much more stable, much safer, correct?
Correct. But that's not the way it works with inflation, because inflation is eroding the value of those bonds. The bond yields have to go up, play catch up with inflation.
So therefore, bonds are no longer the safe bet that they traditionally have been.
Correct. And that's what surprised a lot of people this year. Here's your choice. You could be down 20% in stocks, or you could be down 20% in bonds. Just pick which way you wanted to take it the hardest.
Wow. All right, so wrapping it up now, Mark, no easy solution anytime soon, correct?
None that I see.
Mark Collinsworth, Vere Global Financial Wealth Management. Thanks once again for the update on where the economy is and where it's heading. Mark, thanks.
anytime.